if they do it right, you have to play scheduling hot potato a little bit. The interest on those policies are annual. So as
Okay.
long as the person borrowed the funds, did what they needed to do, and returned the funds prior to their policy anniversary, so the
Mm-hmm.
year, they actually don't have to pay any interest.
You're checking out the Investor Shed podcast with Nick Beveridge and Jeremy Kitchen. They're on the path to financial freedom and they're taking their community with them. Stay tuned for the best free real estate investing advice on the internet.
Hey everyone, welcome to the Investor Shed podcast. My name is Nick Beveridge, here with my ugly co-host, Jeremy Kitchen.
Well, hi everybody, I'm Jeremy Kitchen. This is Nick Beveridge over here.
Yep, definitely Nick Beveridge right here talking.
Your epic pecs, dude, are insane. I
Wow.
just want to touch them.
Pretty epic. I've been working out.
Dang, not
Unlike
this
you,
morning.
Jeremy Kitchen.
Oh, yeah. I missed the gym the last 2 times.
I did.
Yep, no good excuses either. Just, dude, I'm
did.
going to skip out.
He did. Speaking of missing out, you're gonna miss out on this episode if you don't listen to our guest, Josh Heikkila.
We ensure it's going to be a great one.
There's plenty of policies that prove that we are ensuring that this will be a great podcast. Actually, Jeremy, it was a very, very good podcast.
Infinitely better than the last one you just heard.
I'm going to reserve my opinion on it for later.
This episode was a wealth of knowledge for those out there that have no idea what we're talking about.
Josh is awesome. Josh works at Mountain Financial. We talk about the private reserve strategy and just getting your financials in order, which is something I think a lot of people can benefit from. And he talks about these really cool strategies that investors specifically can use and grow their money at the same time. So I got a lot out of that.
I enjoyed it. And you will too. Now, Nick, what should people be eating today?
Ooh, today, while you indulge in this policy episode, I would say get yourself some chocolate milk. And I would say get yourself some Oreos or off-brand Craven cookies at Super One. They're a lot cheaper, just as good, I promise you.
Just as good as Oreos?
Yep, and dunk yourself some Oreo chocolate milk.
Okay, hey, what I did yesterday, I made myself a protein shake out of the whey protein and milk. And then I actually did have some Oreos that I was dunking. I was letting them fall into the cup.
Oh, okay.
Yeah. And then I had a big spoon just like that one.
Okay.
And I would lift up the protein-soaked Oreo and suck on it.
Oh, that's a good idea. I like that.
Extended the life of the Oreos.
That's what we're all about today, extending the life of the Oreos. If you love the episode and you love the content we do, please leave us a review on Apple or Spotify, and only leave us a review if it's 5 stars. Otherwise, we're going to get really mad.
Well, we don't have any 4 stars yet.
Nope. But speaking of good episodes, let's dive in. Ladies and gentlemen, welcome to the Investor Shed podcast. Today we have Josh Heikkila with us today. Josh, how we doing?
Good. Thank you guys for having me. How you guys doing?
Absolutely,
Doing great.
man. We're doing great. Yeah. So I've known Josh I feel like we've known each other for about 8 or 9 months now, right?
Something like that,
Yeah,
yeah.
somewhere around that area. Josh is a really cool guy in the business scene. So Josh works at Mountain Financial. Before we get into that, though, kind of just tell us a little bit about yourself, if you don't mind, Josh.
Yeah. So I've been up here in the Coeur d'Alene area we've been just over 7 years now. I moved up here with my folks and my brother. Just kind of a totally whole new thing that I needed a fresh start in life. So came up here and then met my wife, and now we've got a couple of kids, and we're off and running with all the amazing things that comes with having 2 little kids. So
Gotcha. Where'd you move from?
Denver.
Denver. Okay.
Yep, came up here from Denver. That is Mountain Financial's home office is actually based out of Denver there. So that's how we have that connection. And then, so I run that. And then my wife works at Prodigy Property Management, working with those clients over there.
Gotcha. So how long have you been with your company?
So I've been with Mountain Financial full-time we're coming up on about 3 years here now.
Oh, okay.
I grew up, the family trade was electrical, so I've got a lot of experience in that, came up here doing that. Mountain Financial, like I said, is based in Denver. We were actually clients of Mountain Financial's 10, 11 years ago now.
Okay.
So that's how we have that connection. A little bit before the pandemic, when I got married, it was kind of that like, all right, well, we're adults now. Let's start taking things really seriously and focusing on our money. So I really dove into the money side of things and, what we were taught and the things I had. And the more I dove into it, the more I'm like, I really like this. This is very interesting to me. Implementing all these different kinds of things. And then, like I said, the pandemic came around. I'm like, oh, folks need a little bit of insight or help or don't quite know what to do or have nothing to do anything with. What can I do, to help people out, at that point, just kind of on the side. So started doing my own thing on the side there. Reached out to my now partner at Mountain Financial and just said, hey, what do I need to be doing to have all the right credentials and this and that and all the right things done correctly? He flew me out to Denver. We worked together for a couple of days. By the end of that, he was like, dude, let's do this. Why don't you tell me what you need and take it up to the Pacific Northwest and set you up off and running. So here we are.
I love it.
And so, Josh, what exactly does Mountain Financial do?
So Mountain Financial, to put it plainly, is a fully comprehensive wealth management and financial planning firm. So it's not just the asset management, although we do that, right? We have the full-blown, fully comprehensive financial planning. So we're going to not only be able to offer different resources and different products to clients. So you have the asset management, we have a handful of insurance products in-house, and then we also have a handful of other alternative investment, alternative products that we can help clients get set up with, bonds, real estate investment trust, high yield savings, those kinds of things. What we're going to be doing is full-on financial planning with all of our clients, and then as we work through those different things, we just help them implement, the different pieces that they need. So it's meant to be open, well-rounded, and broad, with options of those things. So it's kind of a brokerage format.
Okay.
So like if we do an insurance thing, I don't have just one company that we go with. We can search for different options, what's actually best for the client.
Sure. Gotcha. Very cool. And I think that comes at a really important time, Josh. Obviously, kind of like what you were saying, like there's a lot of information out on the internet right now about financial literacy and how to be financially competent. You've got Dave Ramsey who says, save all your money, buy with cash, never use debt. And then you've got people like Nick Beveridge here who last year was like, overload yourself with debt because nothing matters.
That was a couple years ago. Last year, rates were high. I didn't say that.
I know, it's a joke. Everyone's heard the podcast before they know your story, so that's kind of where I was going with that. But I do think it's important to have this, financial literacy and what you're saying. So Mountain Financial, they provide these services to kind of help people and guide people in that direction. Is that correct?
That's correct. It's definitely one of the biggest staples of what we do, right? So to a fault maybe even, I literally have had a client sit across from me and be like, hurry up, just tell me what to do. Which then ironically, when we told them what to do, like, well, why? I'm like, well, I was going to show you that.
Right.
But yeah, we do spend a lot of time, and so we tell people, like, look, we've got to look at the whole picture. I don't want to just say, hey, what's your 401k look like? Let's look at your income, your mortgage situation, those retirement accounts, insurance budget, whatever.
Sure.
Let's get all that on the table. And as we comb through those different things, we're going to highlight different aspects of those different sectors where, did you know you could do this? Why are you doing it this way when you could do it this way? Have you heard of this? There's a lot of education and depth that goes into our planning process, as long as the client wants that. Some people are like, just change it and make it work.
Just fix it for me, right?
Right, but there is a lot of insight, and I can't tell you how many times I've heard, where was this when I was in school? Why aren't they teaching us this? That blew my mind. I've never seen that before.
Yeah.
It's just all the different pieces that people just go, man, had I done that 10 years ago, imagine where I'd be.
Sure.
You're right. I think it just gets combed over so quickly when people graduate or whatever else that they don't take the time to learn. It can save them a lot of headaches in the long run.
Right. I'm in my mid-30s right now, Josh, and I got to say, like, financial planning has not been at the forefront of my mind for my entire life, up until just about a year ago. So I'm behind the times. But for someone else like me, like what is the main product or the main solution that you offer people? Is there like one main thing that you direct people to, or is it kind of you just establish what everyone's life is like and kind of go from there?
I'll start kind of from the top of the funnel and work our way down. So what the system that we teach people, the educational material, we call it the Circle of Wealth. It's a nationally recognized, education system. I know there's another guy that teaches it here in Coeur d'Alene. Not sure about the Washington side of things, but I say all that to say, I think, a lot of people when you're like, yeah, financial planning, I don't need that. It's fine. They just assume that I have to have this money set aside. I have to have a high paying income, whatever else it may be. And I think that's why most people don't address it until they're late 30s, 40s, those kinds of things, and I would much rather be seeing people in their 20s and their 30s, and those kinds of things just to be able to get them started on the right foot. So the reason being, and I think this is what helps makes us so different, is as we teach that Circle of Wealth, material, it's not even so much about, hey, how much money do you have? How much money do you make? Okay, give it to me. Let's go.
Right.
Because this is very cold and very cookie cutter, and I don't want to do that. We spend a lot of time working on, we call it wealth transfers, but it's money that people are maybe losing unknowingly or knowingly, but unnecessarily. And then we're going to talk about how can we be more efficient? How can we make sure that your money's liquid, right? Whether that's for an emergency, an investment opportunity, those different kinds of things. I want to, foundationally speaking, minimize the risk for our clients as much as possible. Obviously, if people want to be more aggressive on top of that, then fantastic, we'll help with that. But so having those pieces in place, we walk through their different sectors of their financial plan. To answer your initial question, ultimately what that boils down to, typically to check all those boxes, is what we implement called the private reserve strategy.
Okay.
And it's exactly what it is. It's a strategy, right? That's not some product that we sell or anything like that. There's multiple ways to utilize the strategy. There's just some that you got good, better, best, right?
Sure.
And so we'll teach people that particular strategy. You can use real estate, you can use a stock portfolio, you've got cash value life insurance that you can put into those things. Whatever makes the most sense for the clients at that point in time is what we're going to kind of help introduce them to and help them implement. And that's going to kind of be the primary tool and the stepping stone that's going to allow them to build their business, get into real estate, whatever else it wants. Or if someone's a 9-to-5, W-2, husband and wife, a couple kids, whatever, it works for their retirement as well. It's a really well-rounded, multifaceted strategy that's stood the test of time.
Cool.
So Josh, if we could back up for just a sec, you mentioned a lot of people don't realize, how much they're losing. What do you mean by that? Like, what in general, where are most people losing their money before they get into this?
The number one place that I've seen people where we found quite a bit of money is actually those 401ks, IRAs, those retirement accounts. The reason being is because those are probably the most common product that's out there. That's typically what you're going to find when you go to a place of work or what you offer to your employees, right? That's what you're told, put your money into.
Yeah.
More often than not, people just jump in without doing their due diligence. They do kind of just what they're told to do or what they think they know what to do. Usually what you're running into for the average person, you've got the wrong tax structure in those. So you're doing something like tax deferred, pre-tax, which from, again, most people doesn't actually mathematically make sense.
Right.
And then two, they're cramming a bunch of money into there, and either they're losing it in the market, they're not able to get to it in the event of an emergency quickly, right, without penalty. So then they're like, well, if I want to go buy a property, I'll just, cash out my 401k, pay a penalty, pay this. There's just a lot of hurdles and hoops that people have to jump through to make that efficient. And it's not quite, everything that I think people think it is. The other factor of it too is when you have that tax treatment, and we show people this, when they talk about employer matches, if people are not getting employer matches, not that great of a return overall, or anything besides what they're just getting in the market. Obviously, if you're getting an employer match, that's free money. That's fantastic. But what we show people too is the further out you go beyond your employer match. So if you're maxing out your 401k and your employer does like 3%, it actually has a negative impact on your rate of return over the long haul. And once people see that, that's where you have one of those like moments, right? Where so I could be more efficient, more liquid somewhere else. What does that even look like? To kind of give you some insight into that question, we just did 2023 numbers for the clients that I saw in 2023 and went through and readjusted their retirement accounts and the tax treatment on average. So there are people who are drastically less, but some people are drastically more. We found a projected tax savings of a little bit over $30,000 per person.
Nice.
Wow. So there's a lot more, and that's again one of the things that we teach people is there's a lot more money to be had by avoiding those losses than trying to hit like the big winners.
Sure.
Right? That was essentially $30,000 that I wrote you a check for today versus hoping we get that return in the market over the course of 10 years or whatever.
That's awesome.
Yeah. Do you feel like so overall when you experience or when you do the math and they're actually negative, is that when you like take inflation into consideration, or like how do they get an overall net negative number in general?
Inflation to what we can calculate, right? Obviously everybody knows when it comes to taxes, inflations, those things can fluctuate, right? But that's one of the factors that I've just got a calculator where I said, do you want to know how much you need to retire with? What is this going to come out to? The hard numbers that you can see. We've got that, and we'll show people, here's what inflation's looked like over the course of your lifetime. Here's what it might look like over the last 30 years, and show them based on that, this is probably what this is going to come out to be. This is probably what's going to happen if taxes stay this way, if they do this. If you get this kind of return, you're going to see this. So it's a great way for people to really sit down, see those numbers in their face and go either like, oh yay, we're doing a fantastic job, everything's the way it should be, or oh crap, we've got some adjustments to make, So being able to show people all those different aspects and the impact of it all, it's like you said, it's really increased that financial literacy of just, I've never thought of it like that. I've never seen that before.
Gotcha. So for real estate investors out there, what are some of the most common products that you probably recommend for people that want just a little bit more control over their retirement?
I think, when it comes to real estate, you've got a lot of great things, and I am in full support of that. When people talk about, I've had people be like, I don't want to do stock market stuff. I'm like, great, don't. I don't care. If you want to fix and flip, if you want buy and holds, then let's go for it. Can I help make that easier for you to accomplish? So then it kind of boils down to, we've got a couple things that we can do in the meantime to to hold money and get some good return if stuff's, really short term, they need to get, going on. That private reserve strategy is a really great tool to benefit those real estate investors, right? It takes a little bit of setup. It takes a little bit of time to get off the ground and have the cash flow be, what we want it to be to really make an impact, depending on the person's financial situation. But that tool is really going to help people, maximize and be most efficient, to accomplish their real estate goals. You're getting the right tax treatment. You're getting a good return, with that private reserve strategy. I'm not going to sit here and say it's a home run ball and people are getting ridiculous numbers. We have the freedom and flexibility to contribute into our private reserve how we want to. So if we want to do 100 a month, we can. If we want to do $1 million at one time, we can. Right? The primary goal of the strategy here is utilizing the asset through collateral, right? So you have to be allowed to do that with those different kind of assets, like your real estate, right? A lot of real estate professionals are already doing the private reserve strategy. They're just not calling it that, right? They're using their equity and those kinds of things. It's nice and safe. We're getting, other flexibility, like how we, again, with collateral, it's technically a loan that you're borrowing, against the value of the asset that you have. Can we give you more freedom and flexibility to pay that off on your terms, right? If at all, right? And then, what other additional benefits can we capture with that? So those are the kind of different things where we'll sit down and what what asset does that strategy make the most sense for people, and then help them implement it.
Okay.
Can you give us a real life example of what this looks like?
Yeah, so we have, let's see, who would be a perfect example for that without naming names?
Yeah, I was like, don't use names. I think you'll get in trouble for that.
Or a
dude.
fictitious example.
So, right. No, so we had an individual that now would probably be a good time where they had the numbers just weren't penciling on the real estate. I'll give you two examples. We have someone who's like actively using the funds, and then someone who's getting ready. Excuse me. Someone who's getting ready, they've got a pile of cash. They've got about $250,000 just sitting in the savings account, which, as we all know, is doing next to nothing, right? It's nice and safe, but that's taxable money that's not really growing. So we said, hey, can we take this money, not just spend it all, but gradually move it over time into this private reserve? In this situation for this client, it was one of those cash value life insurance policies where we just systematically move it over time. What that's going to do is gradually give them some sort of liquidity, right, while maintaining other liquidity over here in their account. They're getting a decent return. They're getting the right tax growth, and then when the time comes, what they're going to be able to do is the funds are going to be over in that policy, whatever number that is. Let's just say $100,000. If they need $50,000 to get into a property, do renovations, whatever else, they can borrow against the policy. They're not borrowing from themselves. That's a common misconception with these things when you get onto TikTok and stuff like that. They're borrowing against the policy. They can use the funds, do whatever the heck they want with that. It's, again, technically a loan. The interest on those tend to be a little bit lower. They can do what they need to do. So if they've got, let's just say, $100,000 in this policy, and they need to take $50,000 of it, again, they're going to borrow against the policy. They're not borrowing against or borrowing from themselves. That's a common misconception that you see on TikTok and whatever else.
Sure.
They're borrowing $50,000 against the policy. They can get into the property, do their renovations. The benefit of that is the policy itself is continuing to grow at the 100,000, right? So it's continuing to grow at the full amount, even though they're using 50,000 of it at that time. Those policies, when done correctly, give you really unstructured loan payments as far as paying that money back.
Gotcha.
So you can do systematic monthly payments like you want to. You can, and this is a huge benefit for like the flippers, right? My money's in there, I'm doing my thing, I'm going to have it all done. I need 6, 8, 10 months, whatever I want to do in order to be able to get that done. If they want to do their project, have the property flip in 8 months, and then pay everything back, they can do that. There's nothing that's owed over the course of those 8 months where they have to have some sort of repayment obligation.
Gotcha.
So you're continuing to earn the compound interest, not interrupting it, right? Freely being able to use your funds and having the flexibility to pay back the money as you see fit, right? And then if they do it right, you have to play scheduling hot potato a little bit. The interest on those policies are annual. So as long as the person borrowed the funds, did what they needed to do, and returned the funds prior to their policy anniversary, so the year, they actually don't have to pay any interest.
Okay.
So they can get. So not only are they lower interest, right now they're about 5.5, which is not super low, but lower than most other things out there.
Sure.
Right. If they did have to pay interest, but if they get it done before that policy anniversary, 0 interest. Right. So an investor has the potential to write themselves interest-free loans and do whatever they need to do with a lot more flexibility than what maybe hard private money is going to do, or the banks for that matter.
Sure.
Right. So this person's setting themselves up to be able to do that here in a couple of years once maybe the market is a little bit more favorable, to them. For someone who's got that hands-on experience, they've done exactly that. We've had a client that I think we're probably approaching 7 figures into their policy right now, right? And they've done it both ways. They've got real estate, they built equity into their property, they use the equity via HELOC to get the next property, and they've kind of compounded on that. That's a great strategy that works for that as well. But again, with these cash value life insurance policies, this person has their 900 some thousand now. Same thing. They've just been able to go out and do essentially whatever the heck they want to do. To they did both a personal property that they were able to build up and then rent out the one that they were in, and then also accumulate some commercial buildings as well and build up some apartment complexes. So
Okay.
with that same flexibility, and again, you don't have the bank involved in that as much. The commercial side, you still do a little bit, but on a personal side, gives them a lot more freedom and flexibility.
So, Josh, if I'm hearing you correctly, and I maybe I'm not, so if you only lend against your policy for less than a year, you can potentially double dip returns. Is that what I'm hearing?
The policy anniversary, so it's not, hey, I took the loan today and I have 12 months from now.
Yeah.
It's if my policy anniversary is December 11th, I have until next December 11th. If my policy is July 6th,
Right.
and I take a loan out today, I have until July 6th of 2024 to get all that paid back. Right?
Okay.
To answer your question, essentially, yes, right? You're going to continue to earn right now, 6, 7, 8%, whatever else it may be. Your fund, the policy is going to continue earning that 6, 7, or 8% right now at the full amount, right? Again, just 100,000.
Right.
What you do with that money that you've borrowed is totally up to you. So people can do debt consolidation, save themselves interest, or like you said, I can go flip a property, you get your 15, 20% on the property right on. So now you're getting, you're getting an actual arbitrage of, 20%, whatever else it may be, right?
Do you have to disclose what you're using the money for?
Nope. The insurance company really doesn't care as long as the cash value's in, and that's another reason why it's so effective. If you go do a HELOC, you got to apply, credit check, what kind of standing are you in with your job, those kinds of things. There's a lot of hurdles. With these policies, you call up the insurance company and say, I need 20K, and they go, you've got 40 in here, sounds good, where do you want it? You know, and it's nice. It doesn't matter if you're bankrupt, a felon. I don't recommend being any of those things, but if you whatever the conditions, it's your money.
So could you essentially put the money back in before the policy anniversary date and then take it back out 10 days later and do it again?
In theory. Yeah, I recommend giving yourself a little more cushion.
Okay.
But yeah, you can
just curious.
Yeah, you can rob Peter to pay Paul. If you've got some other fund, you want to pay that one off and then switch back.
Well, I'm just curious if somebody wanted to take this strategy to just play it safe and okay, they're getting, I don't know what kind of returns, like you mentioned, somewhere between 5 and 8 potentially on a policy like this. Could they just take that and then they just lend it out or put it in a money market account to try to get an extra 3, 4, 5% on top of that, and then they keep putting it back and they're just trying to double dip on their returns on a more simple
I've
level.
had people do everything from use the policy to get into real estate. I have one guy that he's funded his policy, puts it back into a brokerage account and trades options with the money, and I don't recommend that.
Nope.
But
That doesn't sound like what I want to do with it, but
no, but he does that and it works for him, and he does, I say options generically, he does some other things that make it smarter, but he's like, why don't I just go earn over here in the policy and then take the money and do my thing? I'm like, that's on you do that. But yeah, you can utilize those other resources to maximize whatever you want to do. Or again, if you find yourself in a debt situation, paying 20% on a credit card, you can eliminate that interest and pay 5% over here.
right.
So what are the ongoing maintenance fees for some sort of a private reserve policy like you're talking about?
There's no ongoing maintenance fees as far as I've got to pay an annual fee, whatever else it may be. These insurance policies, they do take a minute to get off the ground as far as the funds being available because of that insurance aspect of it, like you were talking about. So to kind of use round numbers, and this is stuff that we go through in more depth with the clients, if they just say, hey, we're going to put in $10,000 a year, not all $10,000 they put in that first year is going to be available for them to use. All
Sure.
$10,000 went into the policy. It's not like they're paying some other source and only $9,700 went in. Right, but the insurance company has to get the insurance off the ground. They've got some administrative fees that are tucked into all of their, those kinds of things. So there's a gap between what's been placed into the policy versus what's available. but they're
Sure.
not going to pay the 10,000 plus 20, put 10,000 plus, $100 or whatever
Okay.
throughout the year. That gap over
So
time.
you're saying they're not just giving people free money like right away?
No.
Why not?
Right?
Just kidding.
They got to do business a little bit. So,
Right.
Oh,
no,
okay.
and that's, I know, right? Insurance companies have to make money.
Oh my
Um,
gosh! What?
But that's one of the benefits of, working with us on this strategy is that, it's catered to the specific client's needs. Sometimes we implement life insurance for the purpose of life insurance, right? People need death benefit, they have families. We need to specifically address that. And so a policy might be designed with more death benefit in mind, and the cash value might be not quite as available
Okay.
as somebody else, like a real estate professional who would be like, I don't care, I'm by myself, I don't have family to, keep tabs on.
Sure.
Let's make this as cash value oriented as possible. You can set that up, and that gap between what you've put in and what's available smaller. And then I want to close that gap as quickly as possible, throughout time. So normally, like when you see Dave Ramsey or what other people talk about this, that's kind of one of the cons that they say is it takes 7 to 10 years before what you've put in is available. And I don't like doing it that way. We want to close that gap as quickly as possible.
Yeah. Well, for those that are willing to be patient, let's say, so Jeremy's having a kid here in January. What is there any benefit to him maybe setting up some sort of a policy for his daughter when she's an infant, and then just maybe transferring it to her when she's 18 or something like that? Is there any kind of product that makes sense for doing something like that? If maybe he didn't find the right duplex, to buy and give her like Brandon Turner did. Is there anything like that you guys can put into place that would help him for something like that?
First of all, I had no idea it was January, so congratulations. I thought you had a little more time. So.
No. We're moving and grooving, but I got about a month.
Crunch time.
It's funny. This episode will come out probably when you're having your kid.
Probably right when she's being birthed. Yes.
Yeah.
No, well, in that case, congratulations. I'm stoked.
Thank you. Appreciate it, man.
Congratulations on your kid today, Jeremy.
Yeah.
Thank you.
Preemptively speaking. The short answer is yes. And actually, I've done this with my kids, and again, for all intents and purposes, get it set up and then go buy the duplex with it and have both.
Yeah.
But yes, so you can actually implement this strategy with kiddos. They need a little bit of time. I can't remember what the term for it is, but they have to wait. It's like 2 or 3 weeks for the child to, be in good health and everything, and before they're willing to implement an insurance policy on it.
Okay.
But you can have the insurance policy on the child. They're the insured. They don't have to do medical exams and all that good stuff. They just give them a juvenile rating. And then you, Jeremy, would be the owner, right?
Yep.
Or you and Sam would co-own it, whatever else you want to do. It's your money, and the life is, the child. So 1, you have the coverage of, on the child, God forbid. 2, depending on how you structure that, you can have that fund in place for while they grow up. You can use it for school if they want to do that. If you want to use their funds to buy their car, you can do that.
Right.
Or buy the property, start a business, whatever. And that's actually why we implement it so much for young kids is 1, a lot of other accounts are tied to education. If you don't go to school, there's penalties or other hurdles and things that we have to go through to make it, usable again. You have that freedom and flexibility. You have total control of the ownership of the account, whereas some other accounts may be like, they're 18, hand it over. They're 21, hand it over. Whereas these, you have a total say. So if they're 20 and you're like, I don't trust you with money, I'm going to hang on to it, right? Then you can. The other benefit too is, and this kind of plays along with the adults as well, these policies are a protected asset. Okay, so if you have you have $1 million in your daughter's policy. She wants to go to school, you go to FAFSA, and you say, we need financial aid. They're not going to recognize that policy over here. They're not going to count that against you. So you can still receive financial aid, right, based on your income situation, even though you've got $1 million sitting over here, right? Cool. So there's those perks of it as well. And again, with that protected asset class, if you go bankrupt, people can't come after these things in most circumstances. In a divorce situation, as long as it's yours, The other party can't come after it, right? So there's all those benefits to those as well.
Yeah, and I found that they're super affordable. At least the policies I got for my kids.
Yeah, and you can, and I think that's an area where people are like, it's expensive life insurance. And you're like, well, we're looking at it from a stance of not, I need life insurance, how much does it cost? It's,
Right.
I have X amount of dollars, what kind of death benefit do I get, right? So you
Right.
can set it up to be, if someone wants to do 75 a month for their kid, great, go for it.
All right, so say I came to you with $10,000, right, and said I don't want any kind of really death benefit for my life insurance policy. I just want a cash value policy. So I try to deploy the $10,000 with you. What does that look like? How does that process go?
Yeah, it's very extensive, to put it plainly, right? You've got a lot of different options, a lot of different ways to set it up. I don't want to be someone who comes across as just like, oh yeah, sure, let's do it, whatever. I am going to ask, well, what else do we have going on? What else, is sitting around? How do we make sure that we're doing what's best for, the client in particular? I had someone who actually did that very thing. They're like, I have 10 grand, let's throw it in there. And I'm like, you also have $30,000 in high interest debt that it would make more sense for you to pay that off instead.
Right.
So, but yeah, so it's really a design thing. You've got multiple different options of how much of that $10,000 is going towards the insurance piece of it versus the cash value piece of it, to put it generically. You've got pay durations, right? The shorter the pay duration, the more cash value oriented the policy is.
Sure.
The longer it is, it's much more death benefit. There are situations where, and I'm not sure if this is the case for every insurance company, but the one we primarily use has this. There are situations where, hey, I understand you're not looking for a ton of death benefit, but we are going to actually inject a ton of extra death benefit intentionally, because what that does is it gives us a bunch of extra room to overfund down the road. So if you get lump sums, it allows you to do that, because we do have to kind of hover under a line that our good friend the government has put in place, where as long as we're below that line, we get all those tax advantages. If we go above it, we lose those tax advantages. So we might intentionally inflate the death benefit in an inexpensive way to give people flexibility down the road. But yeah, there are plenty of situations where like, hey, I can do 10 grand a year, no problem. I want it all cash value. And say, sure, and we'll just design it accordingly.
Okay, cool. It's just good to know that there's flexibility in these plans, right? Because I think I'm in the situation with a lot of, I guess, Americans right now. Like, I'm trying to focus on paying off debt, but what you're saying makes a lot of sense as well.
Yeah, and that's why I really, really want people to know, like, hey, this is not meant to be a life insurance sales pitch, right? Mountain Financial, I want to look at everything. And I've told people, you're not doing this yet. You've got student loans, you've got credit card debt, where it makes way more sense to take you're sitting on cash, pay off your debt, right? And then we'll be able to talk here in a year or whatever else it may be. For the people who are maybe in a good spot and looking to get situated, it does make a whole lot of sense to implement this, because life happens. It's not if, it's when, something comes up where they're going to have a bill or whatever. This is going to be a much more efficient, flexible, affordable way to tackle the blown tires, the medical expenses, whatever, when those big bills come up. It's a good way for people to kind of prepare for that as well.
Yeah, absolutely. Anything else you want to add on that, Nick, before we kind of switch into real estate investing?
Yeah, I'm just getting so since you're in the business, I'm really curious. How many people out there are just like way underinsured when it comes to, like how they're set up and how if they died, what they're leaving their family with? Do you have like just a rough idea, just in general, when people pass unexpectedly, how often are they taking care of their family after they've passed?
I think, like, and I'd almost want to flirt a little bit higher, maybe like 95% of people either have nothing or they've got something small that they think will be fine. Yeah, I've not seen much of this at all. There's a good amount. I'd be comfortable with that 95% number. There's people that, it's funny, it's the people that don't need it necessarily that, yeah, I've got this thing in place already. Versus we had a family come in earlier this year. They have 8 kids in the house with another handful out of the home, 0 coverage.
Yeah.
So, and the husband did a relatively risky job, and so we were able to be like, hey, you need to implement this right away, because if one of
Yeah.
you goes, the other person's juggling, a handful of kids. So, but yeah, most people only have either nothing or that little $50,000 through their employer, which anymore, is probably just the expenses to bury and,
Yeah.
move
Drop in
on.
the bucket.
Yeah,
Yeah.
it's not enough.
How many people do die before retirement? Do you have a rough idea?
Oh, geez. I don't think it's that
Percentage-wise?
many. As far as the people that we've dealt with, we've
Yeah.
only had a couple people so far in our practice pass away, and they were older. Other than one, they had a son, I think, right around our age that ended up passing. I've seen more of it lately, I guess, just with, I don't know what it would be, but even just military first responders, those situations, right? Those kinds of things are important where I know the government supplements those things for them as well too, but
Sure.
it's
Yeah.
when you really boil it down and you do the math and you're trying to show somebody, hey, typical recommendation is probably that person's income times 10 years, right?
Yeah.
On average. That's just not happening. People are not having that stuff in place, So
Yeah.
I don't want to be the person to be like, oh yeah, you might die tomorrow and you might need, it's not, I don't want it to be like that. But
Right.
stuff could happen,
Yeah.
Yeah, you don't want that, but like it's been an interesting year, especially for me because I run into a lot of people that have died recently. It's just been an odd last 12 months. There's friends of mine that have died, friends of my wife that are dying, family that's dying, and these are not people that have lived a full life yet.
right?
And it's fascinating to me just how simple it is to put in, just to go get a term life insurance policy that can take care of your family when you're dead. It's not that expensive. I think I pay $84 a month, which may sound like a lot to some people, but that takes care of $1.5 million worth of stuff if I pass that my wife has to work with. And it's not going to change, the fact that I'm dead or anything, but it's a weight off my shoulders just mentally,
Sure.
Yeah.
knowing that if something happened to me, I think financially, I don't think my family has to worry about anything. But before I got all this insurance, it did kind of weigh on me a little bit.
I have seen that quite a bit more, especially with people, they're starting to grow up and have spouses and kids and then accumulating real estate, right? When something comes up, and you pass away, that's something that the other person has to handle and manage, And so even to just have, like you said, it still sucks, that person passed away. It doesn't suck as much as it has to, right? Where now
Right.
not only has this person passed, but now I've got a big bill, that I've got to pay and do all this extra stuff, right? Or how am I going to provide? I was a stay-at-home mom and now I got to go work and do daycare. Yikes.
Yeah.
It's those kinds of things. So I had one that earlier this year, when I first got started, was reaching out to all the friends and family and trying to build business that way. Reached out to a friend. They're like, oh yeah, we should get together. They never did. And she just kind of went MIA for a while. Popped up again earlier this year, only to say that my husband's passed, and they're in their. I don't even know if she's 30 yet, And so
Yeah.
it's just like, it probably won't happen. Most of the time it doesn't. It can happen,
Right.
And so, and I, to piggyback on what you said, the permanent life insurance works really well for the private reserve strategy. We'll write term. I'm not anti that. It's not, whatever else. Let's take care of the family. Let's make sure that stuff's good. And there's options for people to take the term, convert it into permanent down the road too if they want to. So there's the coverage side of things is equally as important, if not more, right?
Yeah. And for those that don't know, too, it doesn't always have to be about the family with life insurance too. I've got policies for business partners. If I were to pass, that business ventures that we're working on should be a little bit more relieving because some money is going to come their way.
Yep.
So do you ever hear of people doing that?
We've had everything from business partners that if something happens, they can buy out the other person, or even just as simple as employers have, it's called key man. You have a high level executive where, man, if we had to replace this person, our revenue would plummet. We got to train somebody. We got to do all this other stuff. Giving them some sort of cushion in their business to be able to kind of weather that storm a little bit more. There's all sorts of stuff you can do with it. I've seen that implemented. You could even go as far as to, as an employer, offer this as a benefit to your employees outside of just the insurance. The employer can make, matching contributions just like you would a 401k, right? Cool. So there's those kinds of options as well.
Awesome. I'm going to ask a kind of a vague question, but hopefully I can get an answer here. So the average person, obviously we're talking about the private reserve. I mean, there's so many accounts out there. There's Coverdales, HSAs, private reserves, IRAs. Like, do you have a core system that you recommend the average person set up with? Because again, I think we should be diversifying as individuals, but we should also be focused on our diversification. Do you have like a core 4 or like a core 6 or anything that you recommend the average person has?
Yeah, I don't know if it quite goes up to 4 or 6, just in the sense of diversification is important. Typically with the private reserve, it's meant to be safe as it is, right? So there's a couple pieces in place where we can bounce back and forth in the event of a market, turmoil in one space or another. But I'm a big believer too in simplicity, right? There's a lot to be said for things being consolidated and whatever else. So in the same vein, I love me some real estate too. So, you have the 401k with your employer, you've got, these life insurance policies or whatever else to be able to do that with. People love their Roth IRAs, whether they're self-directed or not, and I'll kind of tell people like, yeah, those are fantastic tools. I'm not anti those at all. What checks the most boxes? Let's start there and work our way down. And then, anytime somebody has the opportunity to capture something like an HSA or a pension from their company, absolutely go capture that. Let's just make sure that we're doing it with the appropriate tax structure, with the appropriate, contributions. So there's having those pieces in place. I think real estate's good. The life insurance is good. Some sort of other retirement account, be it a 401k or an IRA, is fantastic. And then what else can we capture that might be more circumstantial to that client or that family? Sure.
Just, like you're saying, though, like the real assets, the real estate, the life insurance, obviously important, and then a way to actually have retirement as well. I would agree with you. Those seem like the key ones that I would kind of go with as well. So
yeah, different things have different places, right? We're talking about the life insurance a lot, and I don't want to be some kind of life insurance salesman like, this is all you need. This covers all the bases,
right.
Yeah. Well, Josh, I brought up a lot of those questions, so you don't have to take the heat.
No, I will, because most people are just, if you say permanent life insurance, they, but, there's those pieces of it as well. And then, that's, I think, something we take pride in at Mountain Financial is just, this is about you. This is about your family, and your dynamic is different than mine, which is different than the single person's, that's different than the old person. It's, we have to cater to those specific situations and adjust accordingly.
Sure.
Yeah, and I just want to state this too. I may be known as the guy who's like, just real estate, just get into a bunch of debt. But like for the last 8 years or so, 8 or 9 years, I've had insurance policies that I treat as my retirement accounts. I have not just term insurance, but I've got universal, whatever they're called, whole life, that I've been paying into almost like a retirement account, several $100s a month. So I'm not against it at all. It's just I diversify. I'm just not into the retirement plan, the conventional retirement plans.
Right.
If I wanted to make a blanket statement out there, I like to have more control over my money, and I don't want to be fined by the government if I decide I want to take some money here and put it over here. That's all.
And that's a huge factor of what we talk about too. I think the retirement accounts have their place, in their situations. But yeah, I mean that, to be fair and to your point, that is a huge piece of what we say is I'll tell people when we sit down and look at those accounts, I'll show them all the possible retirement accounts that they could possibly have. And I go, what do all these have in common? They're retirement accounts. I'm like, okay, but then what's next? And they're like,
They take time to build up.
right? They're like, I have no idea. And I go, there's market risk. There's also legislative risk, right? You have other factors outside of your control, be it the government or even your place of work, that has a say in how these things operate. Do you want a little bit more control? Do you want all the control? Right? And that's where these life insurance policies may come into play. Obviously, real estate is a huge factor in that. Right?
Sure.
I'm much more a proponent of liquidity and freedom for you than, let's just cram it into account. I'm going to hold your money. Uncle Sam's going to hold your money, and good luck.
Right.
Yeah. We're going to invest in mutual funds. Yay.
Yeah.
Right. And I mean, like, to kind of counter your guys' point a little bit, like, I have a self-directed IRA that I just started last year. It's got, excuse me, I've got the maximum $6,500 contribution in for the first year. That's going up to $7,000. Not a lot of money, and that's okay. That strategy in particular was something that I didn't want to throw a lot of money towards. I just wanted to plant a seed and watch it grow over time, right?
Nothing wrong with that.
Right. And then, but I can also do that with these accounts and just have it be a little bit more tailored to things that I can utilize. Because with my self-directed IRA, like, I can't touch it. I can't invest in it myself. I can't personally take it. I could give it to either of you guys. And that's what I want to do with that. I want to help people make their investments with that account specifically, but having other accounts like you're talking about, the life insurance, where I can use it for my own benefit, is highly beneficial.
Yeah, absolutely. And again, everybody's circumstances, cater to different things. And so we implement that stuff. I have a Roth IRA, and I personally, maybe I got to be careful what I say here. I personally have a Roth IRA that I will take funds beyond my policy. I like the stock market, so I will invest in individual stocks. I do covered calls. It's what I like to do. If that's people's thing, have at it. I don't ever really endorse crypto, but if you're going to do that on the side, like, go for it, I guess. But we dabble. Those other things, for sure.
So Josh, if you don't mind, I know you're not going to give recommendations here, but if we could explore, since you are in the business, you get to see all the products that are available. You get to, you're investing in real estate, and I would imagine you have maybe some insurance products and stuff. Can you tell a little bit of tell people about what you have set up for yourself and why it works for you?
Yeah, I have no life insurance policies, and I hate no real estate. No, I just no, and that's that.
And this show just got off.
And I don't do anything I preach. So send your monies, and we'll pray for you, or something like that. I love it.
Well, hey, I know you joke around about it, but aren't there people in your industry that do preach all this stuff, but they don't do it themselves?
Yeah, whether the super generically speaking, whether they lack the ability to do so, or the acumen where they don't really understand what they're getting into. They have a script that they can read you and push people through the door, and then oops, that's not how that works.
Right.
Because these policies, the products, the strategy of itself makes sense. The insurance company you use is a factor, right? Different insurance companies don't do different things versus the others. The universal versus the whole versus the term. Those things play a factor. So for me, my wife and I, we each have a whole life policy. I've got another term on top of that to supplement, the death benefit there. And then each of my kids has a whole life policy as well to do that kind of growing up fund as well. From there, we each have...
So what was your plan with the kids then?
At the time when we got it started, our income was kind of where it was at. It was, my wife is very passionate about the safety nets and having things in place where, God forbid, if something happened to a child and we were just, that's horrifying, right?
Yeah.
So the death benefit was a factor into that. If she's like, there's no way I'd be able to go back to work, for an extended period of time.
Yeah, totally.
So that was a
People
factor.
don't think about that.
Right. There's the implications of that they're awful. And I tried not to bring that up when we talk about them, but
Right.
It is something that needs to be considered, right?
Yeah, because people have had kids that have died.
Yeah, it happens, and so to again make it not suck as much as it has to, right? Is a good plan for sure.
Yeah.
The freedom and flexibility that comes with that, again, I'm not a huge college education person. For the generically speaking, obviously certain industries require it. And so to me, I didn't want to be stuck in, well, if we don't go to school, then now we're stuck holding the bag. It just, I joke about it to people, but it really is a factor in my head that if my son grows up to be a punk, I'm not handing him over the money. Like I'm going to hang on to it.
You got leverage. Never mind. I'm going to keep this kid. I've been paying into it.
Yeah, and that's just the way it is. And so that factors in as well. So
I do like that.
That gives us the control again. So, and it's safer. I think I have a pretty good idea of the stock market, but you just don't know, right? So if I could sit there and bank on this stuff's what's going to happen when my child is 18, that's helpful, right? So we have that. My wife and I each have IRAs. I have an HSA, and then I do have a brokerage account that I, am able to do a lot of my personal trading and stuff in that I do not recommend other people do. Okay. So, but I enjoy
Just
that.
use it for entertainment only, right?
Do your own thing, not investment advice.
Yep.
But I enjoy it, and so I do that stuff as well. On the real estate side of things, like I said, we have one property that's out there right now. I've been able to do a good amount of buy and holds with my parents in the past, and that's been really good experience. Right now, my wife and I have been looking to implement we live in the house that we currently live in. We're going to build another one once it becomes available. We'll rent this out and kind of do that trail, right, where you kind of can get into it and then build up behind you. Maybe some other properties as well. But we meant to implement that sooner, and then those kid things happened. Those suck up some money. So that kicked our can down the road a little bit. But have had good experiences, I think, across the board in the different investment options or fund options as well.
Nice. And I do want to just plug a little bit here. So obviously we've done a hard money deal together before. So you've got that going out in, is it Blanchard, right?
Yep.
My lenders loved you, by the way. You guys were willing to put down so much money up front. That was great. Thank you for that.
Happy to help.
So next time you guys want a hard money deal, just do the same thing we did, and we're going to be in good shape for sure. But I want to talk about that deal. Obviously, you guys had it under contract for a little bit, and then it fell out of contract. Is that correct?
Yeah, we've had everything from an offer that we rejected, just because it came in super low, to, we had an offer that we accepted, and it was contingent on the sale of that person's home.
That's rough.
Yeah. And we kind of...
It's a hard place to be.
Yeah, and we kind of knew. But...
There's been a ton of contingent offers this year.
Yeah.
I've taken them on a lot of my properties too, so don't feel ashamed.
No, and I kind of like, oh, okay, this is an offer that makes sense. Let's go down the path with the full understanding that this is probably what's going to happen, especially in December, right? And so...
Right, yeah.
That one fell through. They're like, we're not ready to throw the house on the market yet. So we're still hanging on to it. We're in a great position. We felt like we got a really, fantastic deal there, and nobody's, obviously you want it to happen as soon as possible, but nobody's freaked out or itching or anything like that yet. So it's been a really good process. It's been a pleasure working with you, pleasure working with the other guys, that we're in the deal with there.
For sure.
That's why we were able to put so much money into these things, as we have those private reserves, amongst us. And so we have cash sitting around. So, but yeah, that's been, there's a million other ways to go about it. Right. And so for people that, I have a client doing it right now. Hey man, you on a primary home need to take some time to build up funds, and you can put it over here and take care of yourself. Keep going out there, keep seeing if you can do hard money, private money, share deals with people, like get after it. Don't stop. They just had to be a little bit more prudent with their primary home situation.
And I'm going to try to clarify something here real quick, Josh. So you used your own private reserve strategy for the down payment on this hard money deal, correct?
Correct.
That's amazing. I didn't know that, actually. I just thought you just had like the cash in a bank. Ladies and gentlemen, it works. You can use your private reserve to buy real estate.
He does what he says.
Yep.
It's funny how many times I get asked that at the table when I'm showing that to people. Like, do you do this? I'm like, yes, this is my career. I bank on it. But yeah, we have enough cash sitting around to handle something substantial in the flick of a wrist if we need to. Everything else is allocated into the home or our policies or those other accounts that we can deploy however we see fit. So in that situation, I took funds out or borrowed against it, and then put that into the pot for the Blanchard home.
Okay. So Josh, real quick, we're going to get into the final questions here in just a second, but I just want to ask about that hard money deal. So you guys are going to continue staying the course on that. You're going to try to flip it and just sell it, right? You're not going to try to keep it as a rental or anything?
No, we're going to hang on to it and try and sell it. We've got quite a bit of margin into it,
Cool.
where it's listed at. I would hope that rates continue to see, enough of a decrease where people are going to start having it make more sense for them. And again, maybe this is a unnecessary pat on our back, but we're in a financial position to weather said storm. We don't have to panic and then take bottom dollar. So that's the intent for now. If market conditions change or something else comes like that, or maybe some of the other partners do get a little itchy, we'll reevaluate. But for now, we're in a really good spot.
I think it's good to know that you're in that good spot, right? And because not being in a position to freak out is going to be so beneficial for you and your entire team, because the moment panic starts, it's almost like your plan goes out the window.
Yeah, and you leave money on the table or you lose money, right? And that's, again, there's more money to be had in preserving the wealth and finding money than is just to try and go out and get it, right? So
100%.
Yeah.
Well, cool, man. Well, hey, we're at the hour mark on the show. So what we're going to do, if that's okay with you, first of all, Josh, thank you so much for joining us. Awesome information. Thanks for providing value to our audience as well. What we do at the end of the show is I have some predetermined questions I ask you just to kind of wind down the show, if that's okay. The first question I'm asking is, if you had a business or investing book you recommend every single real estate investor read, what would that be?
Personal plug. I love it. So it's one that, obviously there's a lot of fantastic books out there. I'm going to plug this because it also ties into what we do as well. I just happen to have it on place. There's this book called The Personal Economic Model. It's a lot less known. This is written by the gentleman who put together that Circle of Wealth educational material that we teach, along with another PhD. The reason why I do that is it's going to lay out in depth, way more depth than I could possibly do today, all those different sectors of what I was talking about with people's financial plan. Here's why you want this tax treatment to be this way. Here's how this private reserve strategy works. Ultimately, that's going to, and the reason why I like it so much is it's not just real estate, I know that, but it's going to address people's financial situation as a whole. And if they want to have all that set up properly and more efficiently, that's going to allow them to do real estate better, right?
Sure.
So that's why I recommend that. Again, it's lesser known, and that's why I like pushing that. Is it's going to teach people a lot of good information that's not TikTok info or the cookie cutter stuff you might see traditionally.
I love it. I've actually never heard of that book. Nick wrote it down. I'm probably going to buy it as soon as we're done here, just because I do think there's a lot of value in being financially literate and having a really good plan together. So
yeah. And if you're out there listening, and you're still listening to this show, Josh is going to send you a copy of the Personal Economic Model for free.
I was just going to say, you guys know a guy. I've got copies right here. I'll just give you the copy.
Email or reach out to him.
Yeah, I've got you.
Oh, dude, I was just joking.
I'll do it.
But hey, if you reach out to Josh, maybe you'll get a book. So how do people get in touch with you?
A great way is obviously, email and phone. I do a lot of social media as well. So if people want to connect on Facebook, want to connect on Instagram, I'm holding out on TikTok dances as much as I can, but those other two, we'll do, I can sit there. So
there's a business side of TikTok too. I've seen it.
It's there, and I'll begrudgingly implement it as well. I know you and I have those conversations as well. But yeah. However, whatever is easiest to provide that contact information, you'll either get a hold of me directly or my direct assistant. and then we'll just talk. I don't want to pressure people. Let's just grab coffee or we have a little introduction meeting that we share with people. They can test the waters, and if they love it, let's do it. And if they absolutely hate it, no harm, no foul.
Cool. So what's your number? Because we may not put it in the show notes.
Okay. The easiest way to get a hold of either one of us is going to be 855-522-5344. And I think all of my social media should just be at Josh.Heikkila everywhere you go.
Yeah.
All right.
And we'll spell his last name so you don't have to. We'll do all the hard work for you.
Yeah,
all you have to
see
do is
that.
highlight it and copy and paste, and you're set.
Yeah. Can't guarantee the phone number though.
So maybe first person, or we can do a contest on who could spell it most creatively gets some sort of prize.
I love it. Yeah. I do have a couple more questions for you. I know we're kind of getting at the end, but so here's a question I'm interested in your opinion on. Somebody gifts $30,000 to one of your bank accounts.
30,000.
30 million. Excuse me. 30 million. It's 30 million question. If somebody gifts $30 million to one of your bank accounts, what do you spend it on?
Oh man, I'm going out and splurging and buying new cars and crypto and whatever else.
Crypto.
That was a horrible investment advice. Truthfully, systematically, if I had any outstanding debts, that were a higher interest than what I could be earning, I would pay those off. 30 million, probably going to take care of my wife a little bit, my mom a little bit, those kinds of things. It's a convenient answer, and this is something that we do a lot. When people have the cash sitting around, like I said, we're going to systematically place it into these life insurance policies over time. You have to do it systematically for tax reasons and liquidity reasons. The reason being, again, it's not to peddle life insurance. It's by having it in there, it's going to be the tool that allows me to kind of fire off at other opportunities in a more efficient manner, right? So, any high interest debt, that's got to go. Let's have a little bit of fun with it, and then let's systematically place it somewhere where it's going to be safe, growing, and we can do a lot of things with it.
Yeah, I love it, man.
Cool.
Well, cool.
Well, thank you, Josh. Thank you. You definitely ensured that this episode would be great, and you're such a wealth of knowledge.
I love it.
It was in our policy for you to talk about that at the end, so I'm glad you brought that up.
All right.
That made my whole day right there, just all the dad jokes. So,
I love it.
All right, everybody. We will see you next week.
Awesome. Thank you so
Appreciate
much,
it.
everyone.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.